Welcome back to Morning Trade Live. Whenever we get red in the market the last month, it's been isolated mostly to the small caps. However, in the last 5 days, we've seen a little reflation theme creep into the market, and the Nasdaq's been lagging just a little bit. Let's bring in Jay Pastricelli and talk about how he's viewing the market right now. Managing Director at ZEGA Financial. Jay, always good to have you on the show. Long time no chat. Welcome back.
Yeah, thank you very much, Oliver. It's been a while. Glad to be here.
Thank you. So walk me through how you're viewing the market right now. We've got this COVID situation lingering again. We've got inflation concerns. Everyone at the Fed seems to be getting hawkish besides Powell, so who knows what that's going to lead into. Where are you looking at things right now as being the most important for your decision-making process?
Yeah, we're hearing from a lot of clients that are obviously well aware of the inflation situation, which obviously you just spent a lot of time on, which I agree deserves plenty of attention. And they're also concerned about the reopening trade, right? As this bull run that has been so strong in the beginning of this year, is it almost about to run out? And so the message that we give, right, in these scenarios is manage your risk. But hard to manage risk in your traditional fashion, which is getting, long bonds. You just talked about the volatility nascent within the bond market itself, and it's hard to use that as kind of diversifying agent. They carry significant risk all on their own. So our answer is to hedge. We like to bring, hedging to the forefront as a way to lock in gains, but not trying to time when to get in and out of the market. It allows you to stay long the market and continue to, manage your risk at the same time. You mentioned the Nasdaq. You're right. The Nasdaq has been the most tied or inversely tied to interest rates, and so that has been a concern of ours as well. But you can hedge the broader market and still capture a lot of those mega caps that are included in the Nasdaq. And so, we like to use options to create that protection, as you know, and right now with the VIX hovering 16, 15 range, it doesn't get much cheaper this year than to put on a hedge to lock in those gains. You could put on an at-the-money hedge that'll, take you protected down to say 15% lower between now and November for only 2.5%. And so it's one of those things that we tell clients that, hey, if you're really concerned, right, this, I think you said if this market will ever pull back. I love that comment. If you're really concerned about, the market having a correction or getting into bear territory again, spend 2%, limit your risk, but stay invested, right? Trying to get in and out of this market can be expensive on the side that you miss future appreciation.
Hey, Jay, when you talk about this approach, is this mostly for an advisor that has a wide array of clients and an overall relative beta to the market? Is this thinking about someone who has broad market exposure or index level exposure? Because the reason I ask is a lot of it depends on how you're trading, right? Because if you were just loaded up, say, on high growth stocks in February, if that was the skew of your portfolio, you got bear markets in Tesla and everything around it in its category. But the Nasdaq, if you owned puts, you never would have gotten paid.
Yeah, no, this is a broad-based market strategy, right? So you mentioned a minute ago, right? The Russell is yet to recapture all-time highs. The Nasdaq is close as well, bouncing up there, but the S&P continues to be the one that presses to all-time highs. And so from an advisor perspective, which is what we are, most of our clients are advisors, we talk to them about staying in the S&P, using the S&P as their broad-based exposure to stocks. And so that's the vehicle that will hedge. And you're right. So while even though Tesla will impact the Nasdaq and the S&P a little bit, being more broad in the mix of value and growth included in the S&P 500 seems to be a better mix. But Oliver, where else are they going to go, right? I mean, unless you're going to try to pick stocks or try to time the market, it gets really difficult to do that. So staying in the broad benchmark that advisors use for goal-based investors is really important.
Okay, so you're looking at doing this via collecting a premium by selling a put spread, right?
This is a long put spread where we're buying the 4.
Okay, long put spread.
Just about at the money, yep. And it's about $10 is about the cost for it, just under $10, which is why that expense between now and November is 2.2, 2.5%. Might be a little higher at the open this morning, but yeah, it's a long put spread, and we funded a little bit by selling that out of the money put that's 15% away at that 375 level. Okay. That really does help fund some of the expense if the market drops.
So we're talking a range of what? As long as it doesn't go down more than you said 15% is the strike you're selling, the 375 SPY?
That's right. That's right. So this will kind of protect between now and November down to 15%. And why did we pick November, right? November kind of gets to include the September, which is historically the worst month of the year. And October, well, we know you can get nasty moves in any October, just seems to fall in there. So those 2 months end up being probably a little more perilous than, say, the period we're in today or even after when you hit the November, December timeframe. So, hedging through November, if you're concerned, that's probably when the market will really show itself if it's going to be bearish.
Now, Jay, what if you think things are really going to fall apart fast? Do you just push up the time frame on this, or do you sell something even further out, or maybe not even sell the put? I mean, what if you're really worried that in this moment we're going to get some rate spike and things are going to drop 5 to 10% in a short period of time?
Yeah, managing the trade is just as important as knowing when to put it on, of course. If the markets drop quickly, that put spread will start to appreciate. Rolling it down as the market's dropping is a good way to lock in some of those profits. You have to be able to take profits on a hedge when you put it on. And, and timing it exactly, it'll never work out that it's exactly when the November expiration rolls around, right? So, you have to be able to manage that position. But I'll tell you, Oliver, not everybody is game for doing that. A lot of people, prefer to have managers like us do that for them. And, it's one of the reasons why we actually recently went out with a hedged ETF that we launched about a month ago. And so if you're, want to do it yourself, manage the long put spread, that's great. Get into it. And as the market drops, you're either rolling it or you're flipping it from a bull to bearish spread as you think the market is bottomed out. There's ways to do that. But, alternatives are use a managed product, use a fund. Our fund, like I said, just went live last month. The ticker is ZHDG. It's meant to be a hedged product. It's a little more complex than just buying puts. We use calls as stock replacement, but it's one of those things that if you could do it yourself, if you're an options trader, which we know that a lot of option traders love to watch TD Ameritrade Network, but some folks just would prefer to have a professional do it for them.
So is it, Jay, ZHDG, the ticker, is that in lieu of an overall fund for the index, or do you own it on top of your equity position already?
Yeah, it's a combo of long exposure to the market along with risk mitigation strategies that kind of limit the risk to 8 to 10% over a 10-month period.
Got it.
So,
okay.
that vehicle itself does both. So you don't have to use this just as a hedge piece. You can use it as really to help you meet the goals that you're driving for if you're looking for 7, 8, 9, 10% a year.
All right.
This is what this is designed to do.
Okay. ZHDG, not to be confused with the sensational news website. I like it, Jay. Appreciate you joining us, and thanks for the thoughts here on how to protect a portfolio if there is some market bumpiness. Jay Pestrichelli is the managing director at ZEGA Financial. ZHDG is the fund. When we get back, we're going to talk some